While acknowledging the market headwinds, Mitnick emphasized that many professional investors see the current downtrend as an opportunity. Some of the most sophisticated Bitcoin accumulators we speak with are treating this dip as a buying opportunity. Alrighty, what's going on, everybody? I know we already did a fundamental Zoom call today, but I was just dabbling around, reading some documents, reading some research reports, and some fundamental analysis. Um, and I wanted to not necessarily speculate, but just kind of take a historical look back as to why I was so bullish back in 2022. If you were a part of this community, back in those days when everybody else was fearful, especially during FTX and the whole debacle that took place. We were buying significant amounts of crypto. And we had backed it by research. We were paying attention to panel discussions. And so I just kind of want to touch base there, start there, because I'm seeing almost a similar environment to them that we're seeing now, where institutions and hedge funds and asset managers are doing one thing, and then retail is doing another thing. The thing that retail is doing is they're reacting based off of fear, based off of emotions, based off of irrational decision making because they've over leveraged themselves or they've put too much of their mortgage payments into crypto and now they need their mortgage bills. Like whatever the case may be, just retail traders across the board and investors alike are reacting right now based off of emotional uncertainty. You can see that even being mentioned from, recent Fed comments. This is from March 31st, 2025. Fed Williams said today, uncertainty appears to be impacting behavior in the markets, right? And so I'm just attempting to take an institutional approach. I constantly watch these panel discussions, I read these documents, and I'm going to be completely honest with you. The only reason why I was buying crypto back in 2022 and became a millionaire last year off of those investments is because I was doing what the retail herd wasn't doing. I wasn't being fearful. I was buckling down, doing research on the investments that I believe are going to last long term. Not saying that the ones that I'm investing in are going to survive. I'm just saying in general, I'm trying to continue to become a successful market participant. And I'm trying to show you guys without boring you to death how I've been doing that. And so Frankfurt Digital Finance is a really phenomenal platform for you guys to tap into these panel discussions. They host these, events. I'd say maybe like once per quarter, and they drop hundreds of fundamental breakdowns. And so back in 2022, I was watching a panel discussion of a gentleman. I don't remember what financial institution he was from, but basically on stage he was talking about how, given the market uncertainty, the crash that just took place via FTX, we as financial institutions are not seeing this as a failure. We're not seeing this as anything bad. It's more so just an opportunity.
So the key point is also you're making the FTX disaster and the other disasters we've seen have not led you and your colleagues to close down crypto projects and so on. Yeah.
Absolutely not. Rethinking it and just focusing on the real necessary points, but not stopping it, not at all.
Perfect.
Well, if I may take what you just said on the FTX crash. Basically for us as a bank, it was just a perfect moment. Perfect moment. Things like this can happen, and that's what we are actually standing for actually centuries. So we are really looking at regulation is actually nothing which is harming you, nothing which is stopping us for doing business, but it's actually enabling a real business, a reliable business, a trustworthy business with continuity. And exactly as I said, Jan, it might take a bit longer at the very beginning, but therefore we do it in a right space that especially corporate customers, institutional customers can rely with the business parts on what we are doing. So therefore on the crypto side, I totally agree. We might have a winter, but I mean here in Frankfurt, winter is actually 4 weeks. So it's probably passing by relatively quickly. So we have to see as banks that we don't miss the time.
Right? They're seeing it as an opportunity not only to build the infrastructure stronger, but also to get into the markets at a discount. And they were talking about how back in 2022, the market had discounted itself all the way to where it was prior to that in 2020. And I saw that video breakdown and I started doing deep research on what institutions were actually doing. And same thing that they're doing now, they weren't selling their long-term positions. They were actually accumulating more long-term positions and de-risking themselves with arbitrage and trading positions that have leverage back behind them. And so again, I'm going to show you guys full circle how I'm seeing that similar setup amongst financial institutions talking about this now in the moment. So just as an example, right? This lady right here, we shared this in the chat. This still only has 116 views. And just like how back in 2022, I was paying attention to stuff that barely has any views. Look at these videos on Frankfurt Digital Finance, 175 views, 200 views. Guarantee if you go back because you can go back historically and watch some of the old videos. If you go find that video that I'm talking about, which I'm sure is still on here somewhere, that video will probably still only have like 80 views. Okay. And I'd say that 10 of us were people in this community at the time. So what are we seeing now today? We're seeing large financial institutions like Signum. Just the other day, this was shared in the chat, stream 5 days ago, and Caitlin, head of investment research at Signum, is openly pretty much saying the same thing, that right now we're seeing the worst market conditions in history. Even worse now are market conditions than they were back during FTX, but large financial institutions are not selling out of their long-term position.
That they're actively exploring ways of how they can purchase Bitcoin in budget neutral ways. Then we also have institutional adoption, really proceeding. And here I would like to make the point that, the Bitcoin ETF inflows and outflows, I think, have confused people and definitely affected sentiment negatively. But when we look at the period of outflows and then the period of inflows, and we overlay it with futures trades of hedge funds, there is data on this, then we can kind of dissect whether it was market neutral transactions or whether it was actual institutional buying or institutional selling. And the evidence is that when we saw a lot of outflows, that was overwhelmingly closing market neutral arbitrage positions. So rather than institutions selling their Bitcoin holdings, mainly closing market neutral arbitrage positions. So rather than institutions selling their Bitcoin holdings. And recently, when we have seen inflows, that was primarily outright buying rather than arbitrage trades.
Yes, they're closing arbitrage positions, they're closing trading positions, and they are diversifying into safer haven assets like gold, but they're not significantly selling their long-term holdings. Not only that, she actually opens this discussion right here by saying, we've seen over the last 6 months the most bullish fundamentals for crypto that we have ever seen.
Yes, certainly. And I would go even further than calling it good news. I would say that crypto fundamentals have never looked so good.
Okay. And then she goes on to talk about how currently, right now, again, she specifically mentions this being temporary, that right now, crypto is heavily correlated to risk assets.
But ultimately, what we saw was that it affected sentiment, and then sentiment took on a life of its own. And actually, sentiment ended up decoupling from fundamentals to an almost unprecedented extent. Actually, the crypto fear and greed index, which is kind of a measure of market sentiment, was lower recently than in the wake of FTX. And that's crazy. That's crazy. In the wake of FTX, the fundamentals were very poor. Institutions were walking away. The market just had a ton of scandals and scams and fraud, and regulators were very much cracking down and in a, not in a helpful way, not in a let's clean things up, but basically just preventing innovation and preventing business. The political headwinds were very real. It was crypto businesses were getting debanked. It was very hard to get going and to actually build anything in the crypto space. And these truly negative fundamentals justified a better sentiment or a less terrible sentiment than what we saw quite recently. And this gap between the actual fundamentals of political and regulatory support, move on reserves, institutional adoption, all of that going forward is glaring. And I think it really could just happen because the post-election euphoria disappointments just basically left the market without a narrative. They left the market kind of rudderless. And then the vacuum was filled by macro news. And basically, people need something to talk about and something to latch onto. And the crypto market latched onto macro news. And the environment for risk assets has been poor. And crypto just basically moved to exhibit a very, very high correlation with risk assets, but in a high beta manner. So kind of same direction, but going much further.
Right? Because of the market uncertainty in the current environment. And we were talking about that. We were talking about that literally the day before the market topped. This is why it's so important to be a part of this community, because nobody at this point in time, even if you were unable to sell your positions, should have been confused as to why we are at where we are at now. So if you go look at the total cryptocurrency market cap, the market started retreating on December 18th, 2024. Here is our post from December 17th, 2024. If you're new to this community from then, we were talking about this stuff where I said to you guys publicly, the rest of the week will set the tone for the remainder of 2024 heading into 2025. Don't be blinded by greed. Know when the sentiment shifts by knowing what to look for. A pause on rate cuts from the Fed. Hawkish Fed comments. Rising UK inflation leading to a pushback on Bank of England rate cuts. Bank of Japan rate hikes or any hawkish comments from the Bank of Japan that leads to yen strength. Geopolitical escalations and tensions in the Middle East, Russia, Ukraine, and Trump tariffs leading to an increase in inflation. These are a few of the risks that remain, just to name a few. Understand the markets in which you trade and invest in. Riding the waves will become relatively easy. And literally in order from everything that I was talking about the day before the market pulled back, we have the Fed's pivot, right? Hawkish comments from Jerome Powell on December 18th. Okay, so I said, hawkish comments from Federal Reserve and pause on rate cuts, right? We saw that. I also mentioned a pushback on rate cuts from the Bank of England, right? Due to rising UK inflation. Here, just looking at the most recent articles, this is from March 20th, 2025. Bank of England raises the prospect of pauses in rate cuts, i.e. higher for longer, interest rate environment. That prediction came into fruition. Yen strength, right? We talked about yen strength being one of the catalysts here. After that, we talked about geopolitical tensions. We can still see that ongoing in the market right now. Same thing, we talked about tariff implications happening and taking place. That is still currently ongoing. And that is, again, why we're seeing a massive demand for safe havens like gold. For example, gold reaching new all-time highs at, I don't know what it's trading at now, probably still at $3,100 or some odd, per ounce, right? So I guess the reason why I'm trying to go over this is because so many people are fearful, and I get that, right? If you're a short-term investor, if you're utilizing leverage, if you don't have emotional stability and control over what you're doing in this market and how much you're investing, then yeah, it's painful. But for a long-term investor, even Institutional Scalper just talked about this yesterday in the premium chat, where he left off the message of how he talked about how, the mindset that you have for trading is completely different as a long-term investor. As a long-term investor, this should be seen as a freaking gold mine of opportunity, in my personal opinion. And I'm going to, again, full circle this and show you guys how large market participants from BlackRock are telling you all this. Again, it's like literally I'm seeing the same setup that I saw back in 2022. So I'm just going to click off some more of these links to get rid and speed up my computer a little bit. I don't know why it's tripping right now. So in this panel discussion, since we're on the topic of BlackRock, and before I show you guys some recent blah, 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 what's the word I'm looking for? Some recent panels that he was on, and some recent interviews that he was on. This particular video breakdown was shared just a couple of days ago. It is from Tokenize New York City. And in this specific video, you got Christine Moy. She is the global head of digital assets, I believe, at Apollo, if I'm not mistaken. And you got Robbie Mitchnick, head of digital assets at BlackRock, sitting here. And they're literally talking about earning yield 365 days of the year, 24/7, getting paid. As soon as that deposit hits your bank account, it starts to get, processed through the DeFi ecosystem, and you start generating yield all the way up until you spend your last dollar on your card that's generating yield through crypto.
But I can share with you the vision that I'm working towards, which is, okay, let's talk about how, like today, when I get paid by Apollo, I get a deposit into, my bank account. And, on any given month, I might check my account and say, okay, my credit card bill is going to be this much. I have this much left to, invest. Usually a hot mess and working too much. So I'm like, maybe I'll just put it in treasuries and get whatever the treasury yield is. If at that. And it's like a multi-step process and need to go press some buttons and call someone to confirm it. And then inevitably the next month I have to pay taxes and then I have to unwind out of that and like put it back into cash and then like wait until like my check clears. Now in a future world, and this is what I'm working towards and building with each of you is, I get paid into my crypto wallet. And in my crypto wallet, I have almost like a model portfolio designed that's customized to me. It's going to be 10% stable coins. It's going to be 20% BIDL, money market funds. It's going to be 25% Apollo private credit and like 25% Athena, right?
Give me your pen, Robbie. I got to write this down.
Right. But like, imagine like I have like basically like a customized portfolio to my risk profile that says Christine at all times wants to have her account in this pie chart.
Yeah,
right?
and there's a smart contract that when the assets drop, it deploys.
It deploys automatically. And then what that means is that every last penny of my earnings is fully invested in yielding without me actually having to do anything. And what that means is that every last penny of my earnings is fully invested in yielding without me actually having to do anything. And then, you know, if I'm having Nobu at lunch, and basically I use my securitized debit card that's connected to my securitized wallet, basically like, okay, here's like $100 to Nobu, that's an automatic swap of $100 out of my BIDL into US dollars, into USDC, off ramp, like CU zero hash, off ramp to pay Nobu. And then essentially like that means not only is every penny of my earnings deployed, it's deployed up until the last second of which I actually spend it. Now,
And Robbie Mitchnick is there and gets asked the question, you know, how do you see financial institutions like yourself keeping up with this adoption? And Robbie Mitchnick literally on stage says,
One more question. Do you
Go.
mind?
Thanks for
So,
teeing me up.
all right, so you're a banking CEO, and you just heard this great explanation from Christine. How do you prevent your bank from getting bypassed by some of the things that she's talking about in terms of products?
You have to provide that because they have the incumbency advantage to do that. Right. You have to provide that because they have the incumbency advantage.
you have to provide these options. You have to provide these solutions. And then closing this off, she goes on to talk about how in the near future, we are going to see institutional FOMO after regulation comes in, after all these DeFi primitives and all these solutions can be implemented and adopted by financial institutions. And we are literally on the breaking point of that.
And then, you know, now network effects, you know, and I think this is where, you know, Securitize and BlackRock and Skybridge and others have been leading, but there have been other asset managers pioneering as well, like Franklin Templeton, Wisdom Tree, KKR, Hamilton Lane. You know, I think that every first step is the hardest, but at some point, you know, the risk factors of being a fast follower to all of us on stage, plus all the ones that I've mentioned, you know, has become like the threshold has become much lower. And then soon it actually just like flips into like, why are you not on chain? Like, what is it that they're doing? Like, you know, especially if we start demonstrating use cases that create value, that generate and create AUM, like then you'll see a real acceleration of everyone being like FOMOing in.
Like, I don't think people understand. Even if it were to happen in the next year to 2 years, and it would still take that amount of time, that is still short in the grand scheme of things. Okay. And so at the end of the day, I'm just attempting to show you guys that they're telling you all this stuff, and this is why, and this is how you can back your investment thesis and not react like the rest of the retail crowd and see that the institutions are the ones telling you guys that this is an opportunity. This isn't Cypress here behind the camera telling you guys this is an opportunity. I'm showing you all what the financial institutions are telling you guys, just like they were telling us back in 2022, and then you guys can decide what to do with that information. So check this out. Let's start here. All right, this is from March 31st, 2025. Goldman Sachs flags a 35% chance of recession risks. What does this mean for crypto? Keep in mind, in previous Zoom calls that we did, we talked about the current market cycle that we're in and what happened last time we saw these recessionary risks back in 2024, right? So same thing, like the environment that we're operating in now, 2024 at the beginning, January and February, we saw a rally. Those market expectations of continued rate cuts were dialed back in March 2024 when we got higher inflation data. And from there, we started to pull back. Every single time the market recovered with dovish comments from Jerome Powell, it was always rekindled and dialed back due to some type of market uncertainty. Then in July, rolling over into August, we had the interest rate surprise hike from the Bank of Japan, create some unwinding of the yen carry trade, couple that with recessionary fears due to downbeat US economic data. And we saw that $700 to $800 billion outflow. But when everybody else was fearful, what were the market participants doing? They were buying at a discount from their previous entries, right? Buyers were coming in and defending their positions and overpowering sellers. Yet again, we see almost an identical setup where we're on the verge of experiencing a possible recession. We see recessionary fears lingering. And if the data continues to come out, I've been an advocate of saying how that is short term going to negatively impact the market sentiment. Everybody's going to be fearful, right? And we're most likely going to see a continued suppression of these markets or even a further decline. But when the Fed or central banks in general start to stimulate the economy and finally cut interest rates and start to inject liquidity into the markets, this is going to flip risk assets bullish. And that's again what I feel like a lot of people are not paying attention to because they're so like inclined with the short term. Like, oh my gosh, my portfolio is down because I bought at tops. Crypto sucks. It's a scam. Get out. Right? That's not how this works. So just like how back in 2024, I'm seeing the same setup. We saw a bullish rally due to market optimism of rate cuts, market expectations of Trump implications coming in with regulatory clarity, right? December 18th, just like back in March 2024, December 2024, those rate cut expectations were dialed back. All the market optimism that got pumped into this leg was dialed back, but the underlying infrastructure supporting all of this is still intact. Right now, it's still intact. And that's a fact. I mean, you can go do that research yourself. And so what I'm seeing again is the market continues with these dead cat bounces to build liquidity and build liquidity. But in reality, underlying market fundamentals in the short term are still pointing to risk off. But every single time the market flips risk on intraday for a few weeks, leveraged investors get sideswiped by emotions and they continue to leverage positions. If you look at institutions, they're not selling their long-term positions. They are continuing to de-risk themselves in arbitrage and leverage trades, right? And so why? What do I think is happening? Recessionary fears come in, continue to allow sellers to take advantage of buyers, and sellers push price down into where larger institutions were buying from here. And then we see a rally, and that will most likely all coexist with interest rate cuts when they actually are ushered in. And until then, in the short term, we're most likely going to continue to experience this choppy sideways whipsaw price action where a month we'll see bullish price action. Then the month after, everything will be wiped clean under recessionary fears and further, geopolitical headwinds and tensions and all these things that are creating a temporary risk-off market environment. And I'm just trying to show you guys that they're saying this. Again, this is not Cypress's analysis. I didn't just wake up and conjure this. This is almost an identical pattern that has happened in historical market cycles, and they're kind of telling us this in their documents again. So let me just read thoroughly through this so you guys don't think I'm crazy. Look at this, okay? Crypto markets edged lower Monday following a stark warning from Goldman Sachs, which raised its 12-month U.S. recession probability to 35%, citing rising tariffs, weakening growth, and deteriorating sentiment. The reassessment follows the firm's second upward revision in March to its 2025 U.S. tariff expectations, signaling an increasing fraught macroeconomic environment with direct implications for risk assets, including cryptocurrencies. In the note titled U.S. Economics Analyst, a further increase in our tariff assumptions, Goldman economists Alec Phillips, Tim Walker, and David Miracle outlined their rationale. We now expect the average U.S. tariff rate to rise 15 pp in 2025. Also, the entire revision reflects a more aggressive assumption for reciprocal tariffs. Goldman anticipates that President Trump will announce across-the-board reciprocal tariffs averaging 15% on April 2nd, adjusted for products and country exclusions. The effect rise in average tariffs is expected to be around 9 percentage points. And we can see here in this report, it's saying that President Trump is threatening 25% tariffs. So if the tariff announcement actually comes out and the market's pricing in 25% tariffs, But President Trump dials that back to 15% tariffs or 10% tariffs or 5% tariffs, then the market might see that as an optimistic announcement, right? So again, I'm just attempting to do an analysis. If any announcements from tariffs come out that the market sees as more optimistic or less uncertain, it's most likely going to drive some short-term bullish pressure, right? It's going to alleviate some of the market uncertainty. But then as we continue through this article, it says, the impact on the macro outlook is still stark. Goldman has downgraded its 2025 US GDP growth forecast by 0.5 to 1.0%, lifted its year-end core PC inflation forecast to 3.5%, and increased its unemployment projection to 4.5%. Now, Ron shared a fundamental panel discussion that just took place a couple days ago from a market analyst that similarly talked about the same thing. She sees unemployment rates increasing due to these tariffs and everything that Donald Trump has imposed since he came into office. These revisions reflect a stagnating growth environment paired with inflationary pressures, a combination that constrains monetary stimulus options, right? Then it says here the bank attributes the rise in recession probability to three key factors. So I highlighted this in purple. Number one, a lower growth baseline, deteriorating household and business confidence, and statements from the White House officials indicating their greater willingness to tolerate near-term economic weakness, right? So again, what if they're like literally, you could see it almost in a nutshell that they're doing this on purpose. They can prolong this as much as they want, and they can say things like, oh, you know, we're seeing a greater willingness to tolerate economic weakness. So we all have to suffer while they get a discount in the markets. And then eventually, once everybody else is shaken out, the average household individual is so freaking up to their neck in bills, right? Because they lost their job. They can't pay for anything, definitely can't pay for risk assets. Boom, what happens after a recession? They come in, they inject the economy with liquidity, they cut rates, everybody's got stimulus checks, everybody's happy, everybody gets to pay their bills, and that little bit of leftover money gets put where? Back into risk assets. Like this is straight up like macroeconomics 101 that this is happening right now. Nobody's seeing it. And instead, everybody's being so fearful because of the short-term market impact that this whole uncertain environment is having, but failing to look at the long-term trajectory. So it says here, we are less dismissive of the recent decline because economic fundamentals are not as strong as in prior years. Most importantly, real income growth has already slowed sharply, and we expect it to average only 1.4% this year. While digital assets have long been viewed as an uncorrelation to traditional macroeconomic variables, that narrative has evolved. Bitcoin in particular has become increasingly responsive to broader macro conditions, particularly liquidity, risk sentiment, and real yields. As the yield curve inverts once again, a classic recession signal, macro analysts are warning of a unique policy dilemma. As I'm not going to butcher this person's name, it's a market analyst, noted on X, the yield curve is inverting again, a traditional recession signal. But unlike past cycles, the Fed is unlikely to rush into QE due to inflationary concerns, right? So if inflation continues to increase month over month or year over year in the reports, the Fed's not going to rush to cut, right? This creates a double challenge for Bitcoin, potentially risk off pressure without stimulus relief that typically follows. Bitcoin is very much driven by macro these days. It is behaving like a high beta play on the NASDAQ 100. However, not everyone agrees that a recession poses a net negative risk for crypto. In a recent interview, Robbie Mitchnick, global head of digital assets at BlackRock, offered a nuanced approach and view of Bitcoin's macro sensitivity. He stated, economic fears, I don't know if we have a recession or not, but a recession would not be a big catalyst for Bitcoin in his opinion. It's catalyzed by more fiscal spending and debt deficit accumulation. That happens in a recession. It's catalyzed by lower interest rates and monetary stimulus. That tends to also happen in a recession. Mitchnick acknowledged the short-term constraints, just like I've been telling you guys, right? That right now in the short term, it's going to be painful. It might even be painful for the remainder of 2025. But after the uncertainty subsides, I'm telling y'all, the same setup that I saw back in 2022 and everybody was doubting me is the same scenario and synopsis I see playing out now. That as soon as this current market environment subsides, the underlying infrastructure and the fundamentals that we've seen building up over the past year that have been extremely bullish, that have not been priced into the market yet, are going to show themselves. And so I'm seeing the same exact thing now, where the underlying fundamentals just have not hit price action yet. But when they do, people are going to be freaking mind blown at what takes place, especially people that are doubting the current market environment, right? And that's really what I'm trying to fixate your attention on, is that if you're a long-term investor, you should be freaking comfortable. Let me continue to show you guys that Robbie Mitchnick is telling you guys that straight to your face. So let's go over to this report. This is from Yahoo Finance. This took place a week ago, March 19th, 2025. As of time of recording, it is the 31st. So give or take about a week or so. And this is again from Robbie Mitchnick, an interview that he did with Yahoo Finance. You can kind of watch some of that here. It only gives you a 5-minute, 30-second long snippet of it. But here it reads. Robbie Mitchnick, global head of digital assets at BlackRock. Keep in mind, he was just in a panel discussion literally the other day talking about how they're going to integrate crypto into the financial system and how, you know, you're going to be able to earn yield straight through your checkings account and then be able to pay for things with your crypto card right on stage, right? Global head of digital assets BlackRock, Robbie Mitchnick said a potential U.S. recession could act as a powerful driver for Bitcoin's next bull cycle, citing liquidity injections and fiscal responses as a key catalyst. Despite some optimism following policy shifts in Washington, Bitcoin's performance has been subdued, currently hovering near $83,550 after giving back its late 2024 rally gains. The crypto market may have gotten ahead of itself with expectations about how fast deregulation and other catalysts would arrive. Keep in mind, we covered this in a full-on extensive breakdown weeks ago, talking about how this happened and how this took place and how in 2024 in November during the Trump rally, the markets got ahead of themselves. Literally word for word, we're pretty much saying the same exact thing that BlackRock representatives are saying, right? He noted that while Bitcoin rose sharply into the end of 2024, the early part of 2025 has been marked by the modest ETF outflows and cautious sentiment. Mitchnick argued that Bitcoin's fundamental characteristics, its scarcity, decentralization, and independence from traditional monetary systems, position it as a long-term hedge, especially during periods of economic stress. A recession would be a big catalyst for Bitcoin, he said. It's long liquidity, meaning it benefits from increased fiscal spending, deficit accumulation, and lower interest rates, all typical features of a recessionary environment. While gold has recently surged to record highs amid growing economic uncertainty, Bitcoin has struggled to mirror that trend. Mitchnick attributed this partially to short-term correlations and how the crypto market narrative has leaned into viewing Bitcoin as a risk-on asset. This is exactly what the lady from Signum said. I don't remember where the panel went. I think I clicked out of it, but she specifically said that right now, currently in this market cycle, Bitcoin is correlated to risk. As soon as the market uncertainties subside, none of the bullish fundamentals, though, have been priced in. There's a self-fulfilling element to how Bitcoin is being traded in the short term, he noted. He also discussed the ETF market dynamics, highlighting that recent Bitcoin ETF outflows have been primarily driven by hedge funds unwinding spot futures and arbitrage trades. Right? The core long-term hodlers are still in, he explained, pointing to continued interest from institutional investors despite the volatile price action. Commenting on the Trump administration's establishment of a U.S. strategic Bitcoin reserve, Mitchnick said, it's a strong signal of support for Bitcoin's uniqueness within the digital asset space, though the specifics of how the government might accumulate Bitcoin remain to be seen. While acknowledging the market headwinds, Mitchnick emphasized that many professional investors see the current downtrend as an opportunity. Some of the most sophisticated Bitcoin accumulators we speak with are treating this dip as a buying opportunity, he added, despite the challenges facing the broader crypto industry, including recent hacks and concerns about regulatory clarity. Mitchnick remained optimistic about Bitcoin's long-term role as a portfolio hedge against economic instability, right? And so again, the reason why I'm doing this is because from multiple financial institutions, we see correlating fundamentals. They're literally telling you, just like this lady did from Signum Bank. I don't remember where the panel went. The lady Caitlin or whatever her name is, however you say it. She specifically mentioned the same exact thing. that these large institutions are just unwinding their spot futures and leverage trades. They're not selling their long-term positions.
But when we look at the period of outflows and then the period of inflows, and we overlay it with futures trades of hedge funds, there is data on this, then we can kind of dissect whether it was market neutral transactions or whether it was actual institutional buying or institutional selling. And the evidence is that when we saw a lot of outflows, that was overwhelmingly closing market neutral arbitrage positions. So rather than institutions selling their Bitcoin holdings.
Retail investors, on the other hand, people that put $10,000 into this market back in 2024 in December at the peak, that are now down to $6,000 because the market's tanked over 40%, are telling all their friends and family members that this is a scam and that they lost $4,000 and now they're going to sell at a loss. When in reality, now is when they should be doubling down, not financial advice, and buying high valued assets at a discounted price with a long-term perspective in mind, right? This is again not a leverage strategy. This is more so, and this entire video breakdown oriented to my long-term positions in crypto that I'm willing to hold beyond 2030. I still have a firm belief that we're in a massive super cycle. This is just one of those short-term corrections that is not only healthy for the markets long-term, but also provides us as the everyday average retail investors to put dormant capital that we had been stacking previous to this pullback into the market to possibly see a return long-term. This is again me just showing you guys that these institutions tell you these things straight to your face. They put it out in these interviews, these panel discussions. At the end of the day, some of it's speculative because who really knows what the market's going to do? I mean, tomorrow we could wake up and the freaking market could do this, you know? Like, let's be realistic. Is it likely that it's going to happen? No, not really, because I mean, that would involve massive liquidations and probably a few exchanges and projects going bust all at the same time. Even these little tiny connections, I think it's so cool. I think it's so cool that I'm sitting here and I'm like, yo, what the heck? A dude from BlackRock said this, but a lady from Signum said the same exact thing. Come on now, you can't. It's not coincidence, people. They're sitting in on these same discussions, closed door, behind the scenes. It's like, you know, it only makes sense. Anyways, that's my rant. I'll leave the floor open.